Welcome back to ZBCN Today, the channel where we cut through the noise and focus on what actually matters. To understand the current situation, we first need to appreciate just how massive Siren's rise was. Earlier this year, the token became one of the biggest success stories in the AI meme coin narrative. Combining artificial intelligence branding with the speculative energy of meme coins proved to be a powerful formula. Investors were desperate to find the next explosive crypto project, and Siren appeared to offer exactly that. The token skyrocketed in value, climbing thousands of % within a short period of time. At its peak, Siren reached approximately $3.61 per token on March 22, 2026. At that valuation, the project briefly commanded a market capitalization exceeding $1.7 billion, placing it among the most talked-about speculative assets in the crypto industry. Everything you hear on ZBCN Today is for educational and informational purposes only. Nothing in this video should be considered financial advice, investment advice, or a recommendation to buy or sell any asset. The rally was extraordinary, but looking back, many analysts now argue that the warning signs were visible long before the collapse began. Like many meme-driven projects, much of Siren's valuation was built on expectations, hype, and speculation rather than proven utility or revenue-generating products. Investors were pricing in future success rather than current achievements. As long as momentum continued, that wasn't a problem. However, once selling pressure emerged, the absence of strong fundamentals became impossible to ignore. The latest and most devastating phase of the collapse appears to have been triggered by a massive whale liquidation event. According to blockchain analytics firms Spot On Chain and Look On Chain, a single wallet holder controlled an enormous percentage of the circulating supply and began aggressively selling tokens into the market. Over a period of roughly 48 hours, the whale reportedly dumped around 670 million Siren tokens. The scale of this liquidation was staggering. Reports suggest the sales generated approximately $64.8 million in USDT, while simultaneously crushing the token's market value. What makes this situation particularly alarming is the sheer percentage of supply involved. The 670 million tokens represented approximately 92% of the actively circulating supply at that time. In traditional financial markets, dumping such a large percentage of available shares would be nearly impossible without catastrophic consequences. In crypto, where liquidity can be much thinner and investor sentiment can change instantly, the impact was devastating. As sell orders flooded the market, buyers simply could not absorb the supply fast enough. The result was a near vertical collapse in price. The numbers tell the story better than anything else. Siren was trading around $130 before the liquidation accelerated. Within days, the token had fallen toward 5 cents. That's a decline exceeding 96% in less than a week. Imagine investing $10,000 near the highs of that move and watching the value shrink to a few $100s within days. That is the harsh reality many investors faced during this crash. Crypto analyst Hupsy described the event as a textbook pump-and-dump scenario. According to his analysis, the whale not only liquidated a massive position, but also allegedly distributed remaining holdings across hundreds of separate wallet addresses. This type of wallet fragmentation can make future tracking significantly more difficult for blockchain investigators. When assets are spread across numerous addresses, it becomes harder for traders to monitor potential future selling activity, increasing uncertainty throughout the market. However, the recent whale dump wasn't the first warning sign surrounding Siren. Months before the collapse, respected on-chain investigator ZBCN and blockchain analytics platform Bubble Maps had already highlighted concerns regarding supply concentration. Their research suggested that a cluster of interconnected wallets controlled nearly half of the entire token supply. In decentralized markets, concentration risk is one of the most important factors investors should monitor. If a small group of wallets controls a large percentage of tokens, those holders possess enormous influence over price action. Even if the project appears healthy on the surface, concentrated ownership creates a structural vulnerability that can eventually lead to severe volatility. Despite these concerns, market participants continued buying. During March 2026, Siren delivered one of the most explosive rallies in crypto. The token reportedly surged approximately 6,800% before eventually suffering a correction of more than 90%. Surprisingly, that collapse wasn't enough to eliminate bullish sentiment entirely. Investors viewed the decline as a buying opportunity rather than a warning. This optimism helped fuel a second major rally that pushed Siren back above the $1 mark. For a moment, many traders believed the project had survived its first major test and was preparing for another run toward new all-time highs. On June 8th, the token experienced another dramatic surge, climbing roughly 190% from around $0.45 to $1.30. To many traders, this appeared to be confirmation that bullish momentum had returned. Social media excitement exploded once again. Influencers, traders, and speculators began discussing potential targets far above previous highs. But instead of continuing upward, the rally immediately reversed. What initially looked like a breakout eventually turned into another distribution event, with large holders using the renewed demand as an opportunity to exit positions. The derivatives market also revealed signs of growing instability. According to CoinGlass data, futures trading activity surged dramatically during the crash. More than $625 million in futures volume was recorded in a single day. That's an extraordinary amount of leveraged speculation for a token of this size. Whenever leverage becomes excessive, markets become increasingly fragile because small price moves can trigger forced liquidations. That's exactly what happened here. During the collapse, approximately $3.4 million worth of leveraged positions were liquidated. More than $2.7 million of those liquidations came from long positions. In other words, traders betting on higher prices were wiped out as the market crashed. When long liquidations occur, exchanges automatically close positions by selling assets into the market, which creates even more downward pressure. This can produce a vicious cycle where falling prices trigger liquidations, and liquidations cause prices to fall even further. Another important metric was open interest. Open interest represents the total value of active futures contracts. During the panic, open interest reportedly fell nearly 40%, dropping to around $28 million. This decline indicated that traders were rapidly exiting positions and reducing risk exposure. When open interest collapses alongside price, it often signals a loss of confidence and a significant reduction in speculative participation. One of the most unusual aspects of the crash involved trading volume. At one point, Siren generated more than $224 million in 24-hour trading volume despite its dramatically reduced valuation. That creates a turnover ratio exceeding 5 times the token's market value. According to observations highlighted by Arkham Intelligence, this type of activity is often associated with major liquidity events rather than normal market behavior. Extremely high turnover can indicate forced selling, panic exits, liquidation cascades, and aggressive redistribution among market participants. Beyond the whale activity, many traders are questioning the underlying fundamentals of the project itself. This is where the conversation becomes even more challenging for long-term bulls. Siren AI promotes several ambitious products, including a decentralized exchange and an AI-powered trading agent. On paper, these concepts sound attractive. AI remains one of the strongest narratives in both traditional technology markets and cryptocurrency. However, at the time of writing, many of these products remain listed as coming soon. Recent price action offers some support for this theory. Although Siren suffered another major decline, it managed to rebound from its 24-hour low around 4.024 cents and recover toward approximately 5.8 cents. The 24-hour high near 9.18 cents demonstrates that buyers are still active at lower price levels. This doesn't guarantee a recovery, but it does suggest that some investors are willing to take speculative positions after such a dramatic decline. However, it's important to distinguish between a temporary bounce and a genuine trend reversal. Many crashed assets experience sharp relief rallies before continuing lower. A true recovery requires evidence of sustained accumulation and improving market structure. For Siren, One of the first major technical milestones would be reclaiming the 10 to 12 cents region and holding above it consistently. That would demonstrate that buyers are willing to support higher prices rather than simply buying short-term dips. The token's recent trading range highlights just how volatile the situation has become. Over the past 7 days alone, Siren traded between approximately $0.045 and $1.26. Moves of that magnitude are extraordinary, even by cryptocurrency standards. Such volatility reflects both the uncertainty surrounding the project and the emotional extremes driving market participants. Investors should also remember that Siren's all-time low sits around 2.635 cents, recorded back in March 2025. With the current price only modestly above that historical floor, a resumption of selling pressure could potentially send the token back toward those levels. Markets often revisit previous support zones during extended bear phases, particularly when confidence remains weak. Perhaps the most sobering statistic involves investor losses. Anyone who purchased Siren near its all-time high of $3.61 is currently facing losses approaching 98.4%. Recovering from a decline of that magnitude requires an enormous rally. A token that falls 98% must gain roughly 4,900% just to return to its previous peak. This mathematical reality illustrates why deep drawdowns are so devastating for long-term portfolios. If you're getting value from this kind of focused, fundamentals-driven ZBEC content, make sure to hit the like button, subscribe to ZBCN today, and turn on notifications so you don't miss future updates. It directly supports the channel and helps this research-driven community grow. Drop your thoughts or questions in the comments. I read them all. Now, let's continue with the real analysis.